Good evening, everyone, and thank you for taking out the time and joining the Decoding the Union Budget 2023 webinar. My name is Nidhisha, and I'm the Vice President Market Insights Wealth Development at HSBC India. Before we welcome my esteemed speaker, I would like to just set the tone for today's webinar. The Union Budget is one of the most anticipated events of the calendar year. The asks from the government were laid down pretty clearly for this year. Whether it be reining in fiscal deficit, at the same time balancing growth through capital expenditure, or simplifying the tax structure and trading the path of reforms to bolster further the India growth story. While we all would have heard the budget yesterday, it shall be the keen glance of industry experts which shall help us understand whether the Union Budget ticked all the right boxes. I would hereby like to warmly welcome Pranjul Bhandari, a stalwart speaker from the world of finance. Pranjul Bhandari is the Chief India and Indonesia Economist and Managing Director at HSBC Securities and Capital Markets India. Previously, she has worked at India's Ministry of Finance and various other esteemed institutions. I would hereby like to warmly welcome Pranjul over to share her thoughts on the budget. Over to you, Pranjul.
Yes, of course. Thank you very much, Nidhi, and welcome to everybody. Thank you very much for joining this session. I know there's been an overdose of budget analysis, but let's try to make it exciting. And I'm looking forward to all the questions you may be having after I finish sort of like a brief introduction. So what did I think of the budget? Well, look, I think it was a great example of having your cake and eating it too. I think it was one of the few times when the government has been able to sort of balance some very conflicting objectives. And here today, this time, they were able to bring down the fiscal deficit. And at the same time, they were able to provide some capital push, the Capex push, which is good for medium-term growth. So it's sort of rare. They can't always do it. But I think this time, at least, they've made a strong effort. And it's not just this time. I think over the last couple of years, the government has tried to improve the quality of the spending it does, moving more towards Capex and moving away from, current expenditure. So, if you sort of make a very simple revenue to Capex sort of ratio, you'll see it's been coming down dramatically over the last 3-4 years. And this year was a continuation of that. The government also tried to do a few very important reforms, namely it tried to move individuals towards exemption-free personal tax system. We'll have to wait and watch to see if that is a success or not. And, we can come back and talk about it a bit later. But at least it tried. You want to move towards a more transparent tax system. People don't change overnight. People have been doing things in various ways. They've been used to exemptions, but at least the government tried. And I think, every year it can take sort of more incremental steps until it gets it right. Then the other thing it tried to do was just to give a push to manufacturing. It tried to correct some of the inverted tariff tax structures. We have these big problems in the economy where the inputs are taxed far more than outputs. That actually hurts competitiveness. It hurts our export possibility. So there were some changes made there. And, we can discuss that a little bit more when I sort of come to that section. So there were some reforms also, that happened. But let me sort of, start with the most basic thing, which is the fiscal deficit, because that's really the one number you track on budget day. So what happened to the fiscal deficit was it's coming down. As in FY23, it was supposed to be 6.4%. In FY24, they want to bring it down to 5.9%. It's a good sort of step. They've brought down the fiscal deficit by 0.5% of GDP. Bringing down the fiscal deficit is very important. And I'll give you just one reason why. The biggest reason today, 50% of the taxes that the central government collects is used to service the interest bill. Just think about that. And it leaves no money, practically nothing for important things like health, education, infrastructure. So only if you bring down fiscal deficit over time to sustainable levels, you bring down the interest bill over time, and then you free up resources. As the chief economic advisor put it, fiscal discipline today is a fiscal stimulus tomorrow. And that's why it's very important to bring down the fiscal deficit. But did it do enough? And here, let me complain a little bit because I like complaining. I think they could have done a little better. They have a target of taking the fiscal deficit down to 4.5% of GDP by FY26. And I had hoped that they sort of take it down linearly. They do put the equal amount of effort every year for the next 3 years. I would have liked it if they had brought down the fiscal deficit a little more. But now they haven't. I wish they had brought it down to 5.8 or 5.7. Then the pressure in the next 2 years would have been more equal. Now the pressure for the next 2 years is a little high. And that is one small thing that bothers me. But I told you I like complaining, and you can sort of avoid what I just said. So that was one small complaint. But moving ahead, everybody talks about the fiscal math. Is it credible? And it's a really good question, because in the past we've had budgets in which there's no credibility, right? Like you have some growth number you just don't relate to, and that never turns out to be like that. Or there's some expenditure numbers or tax revenue numbers that doesn't work. So did the maths make sense? And here, a couple of thoughts. They've played it like very conservatively and very gently for on the revenue side. They're expecting, taxes to grow in line with nominal GDP growth, which is sort of, a fair assumption, and I'll come back to that. So as a percent of GDP, revenues don't change at all. Everything that changes is on the expenditure side. Now, the government had really increased its subsidies over the last few years on both food and fertilizer. And just a few months ago, it was able to restructure and bring down its food subsidy scheme. Quite understandable, because, we are over the worst of the pandemic, and the fully free food distribution scheme was turning out to be too expensive. So it just completely makes sense that the government wanted to bring it down. And then the fertilizer subsidy bill is also coming off. And the big reason for that is that fertilizer prices have fallen globally in the last couple of months. So putting the food and fertilizer subsidy bill together, there is an expenditure saving of 0.7% of GDP. And they've used all of this to fund Capex, because the Capex boost is an additional 0.7% of GDP. So it's just basically all your subsidy saving has gone into your Capex boost. Then one more part of expenditure has seen a change. Other current expenditures, which are mostly all kinds of transfers made to states and then state spend, that has also been cut. The central government sort of calls it more efficient spending. Some other people call it the squeezing out of states. You can call it what you like, but for the central government, it has been an important way to consolidate its fiscal deficit. So it has cut that by about 0.5% of GDP and used that money for fiscal consolidation, for bringing down the fiscal deficit. So that has been the math, and I don't have a problem with the math. But every math is only as good as the assumptions it's based on. So am I happy with the assumptions? So the first assumption is nominal GDP growth. They've assumed 10.5% nominal GDP growth. I would have been, happy with something like 10. My own estimate is 9.5. I could have been happy with 10. 10.5 seems too high. 10.5 assumes real GDP growth of 6.5%, and then there is some inflation. I would have preferred a real GDP growth of 5.5% with some inflation. And the reason is, I'm seeing my forward-looking indicators suggesting to me that real GDP growth is going to slow down. Exports are slowing. Exports have been a huge contributor of India's GDP growth in the last couple of years. But it's slowing now because demand globally is slowing, because globally there have been so many shocks, interest rate hikes, commodity price shock, high inflation, that demand generally is slowing. So, that is one reason. And even in our own country, when we were locked up in our houses in lockdown, we saved a lot of money. Deposits at banks really went up. But that saving has fallen. That deposit at bank has fallen. It's gone back to pre-pandemic levels. In fact, it has gone below pre-pandemic levels. So households don't have extra firepower to go and spend right now. So you can't expect too much growth coming from there. In other words, it's the same thing as saying that the recovery from the pandemic got us growth, but the recovery is complete. So we can't get that growth again and again, year after year. So for all of these reasons, my sense is that GDP growth will be slower, and I would have been happier with a slightly lower nominal GDP growth forecast by the government. The other assumption it has assumed is sort of a little technical, which is on revenue growth, on tax revenues. It has assumed same as nominal GDP growth. 10.5%, which is basically known as tax buoyancy of 1. That you're expecting revenues to grow at the same rate you're expecting nominal GDP to grow. Now, that's a very sensible assumption for any normal year. But I think in a year where GDP growth is falling, generally we find tax buoyancy also falls. And the reason we find this is because many firms and individuals fall below the minimum threshold of taxation. So generally speaking, tax revenues grow at a slower pace than nominal GDP growth in years which are seeing some amount of slowdown. So I would have preferred a slightly lower tax buoyancy. And I think that's where the revenue estimates are a little rich and it's bothering me a little bit. Then there are other parts of revenues, privatization receipts. Again, the government has come out with a slightly aggressive privatization receipts. And to be very frank, I think it's overestimated because especially in a pre-election year, that's this one activity that comes to a halt. You don't sort of want to do any major controversy by sort of selling a PSU. So that comes to a halt. But I'm not going to bother too much because there's this another part of revenue called RBI dividend that I think has been underestimated. It's been estimated at about 480 billion. I think it can be about 200-300 billion more, simply because the RBI has made a lot of money this year. Through August and September, it sold a lot of dollars to stabilize the rupee. And whenever it sells dollars, it realizes profits. And RBI is going to sort of mark the year, which ends in June for the RBI. It doesn't follow a March fiscal ending. It follows a June fiscal ending. So when it ends the year in June, it's going to end with a big profit, which it will transfer to the central government as the RBI dividend. And because it will be higher than budgeted, it will offset some of the losses in the privatization front. So all told, privatization and RBI dividend will cancel each other out. And we are left with this tax revenues, which are probably going to disappoint a little bit. At least that's what I believe. But does that mean there's going to be a slippage on the fiscal deficit? And the answer is no. Because I think if you have a shortfall on revenues, you can also have some shortfall in expenditure, and overall the fiscal deficit won't get messed up too much. So let's move on to expenditure. The big item in expenditure is Capex, huge capital expenditure. In FY24, an increase of 0.7% of GDP. My problem is that such a large increase in Capex is just not possible in any one given year because of implementation bottlenecks on the ground. In fact, the last time when we made a 0.7% of increase in Capex was back in 2008. That was a very long time ago, and that was a period of very strong private investment, huge amount of liquidity. But, we don't have all of those supportive factors right now. So my sense is at this point, getting a 0.7% of GDP increase in Capex is going to be tough. In fact, the maximum we have achieved in the last 1 or 2 years has been about a 0.5% of GDP increase in Capex. And instead of 0.7, if it's 0.5, we automatically save 500 billion rupees, and that goes to fund any shortfall we may have in tax revenue collections. So my point here being that there are different parts of the budget that could offset each other, and overall, we may still be able to achieve that 5.9% of fiscal deficit that the government has accounted for or budgeted in the budget yesterday. All of this is very important because it has implications on borrowing. Every time the central government runs a fiscal deficit, it has to fund that fiscal deficit and it goes into the market and borrows. And honestly, that's the one number the bond market looks out for. What is going to be the gross market borrowing? That sprung a positive surprise. It came out to be something closer to around 15.4 trillion. Some parts of markets had feared that it could be very high. It could be north of 16 trillion. So the markets in general, at least the bond markets, were happy with the gross market borrowing. It's my problem there again is that I think the relief that the markets have got is a temporary relief, because you can't look at gross market borrowing just as a standout number. You have to think about it. Fine, we are going to supply so many bonds. Who's going to buy it? What we had last year was India's banks buying bonds. India's banks bought and bought. And the reason they bought was because credit growth was on fire, growing 17% year on year. And whenever you grow credit at such an ambitious rate, you end up buying a lot of G-Secs because you have to maintain the LCR ratio. So there was a lot of internal demand for G-Secs, government bonds, that got created because of regulatory issues. But if credit growth were to soften in line with softening GDP growth, or in line with softening inflation, because you see a lot of that credit growth was on the back of working capital needs. You had inflation so high, raw material cost was so high, but oil has fallen from $100 a barrel to 85. Many other commodities, have softened a lot. So if the working capital needs are low, and then GDP growth is low, demand is low, credit growth is low, then the banks may not be that excited to buy so many government bonds. So who'll buy it? And I think that is something which the bond market will have to grapple with as the year progresses. A lot of people towards the end ask that, you think the RBI will help? You think the RBI will come and buy bonds and help out? Which is basically another way of saying open market operation, open market purchases. And my sense here is that there are many moving parts, but if we have an external account imbalance, if we have a huge BOP deficit next year like we had last year, and the RBI is forced to sell dollars to stabilize the currency, and it withdraws rupee liquidity, then only it may buy bonds to replenish back that domestic liquidity. It's getting a bit technical, so I don't want to really harp on that. But I think the bond market's next ask is, will RBI help us? And the answer to that is, we don't know. It depends how the next couple of quarters pan out. So there's going to be some uncertainty that comes into the bond market going ahead. In terms of the themes that the budget sort of focused on, as I said, it was Capex, Capex. And, from morning, I'm speaking to so many equity analysts and equity investors, and everybody has a different number. Is it a 37% year-on-year increase in Capex? Or is it a 30% year-on-year increase? Or is it a 25? So there are a lot of moving parts. If you look at only the central government outlays, it's a 37% year-on-year increase. If you add to that transfers to states for Capex, it's a 30% year-on-year increase. To that, if you add public sector enterprises Capex, it becomes a bit lower, 28% year-on-year increase. And if from that you reduce some of the things which they're calling Capex, but it's actually not Capex. For example, Food Corporation of India borrowing to fund some of its previous losses. If you sort of take out all of that little unclear stuff, then it's a 20% year-on-year increase in Capex, which is also a very large number at a time when nominal GDP growth is only 10.5. So cut it any way you want, there is a Capex thrust in the budget. Where is this going? Railways, roads, telecom, other main sort of sectors. There's a little bit for housing as well, but generally the infrastructure sectors. But what gives? You can't just have everything, right? Like, growth is slowing, fiscal deficit is falling, you're doing Capex, what's giving? And I think one of the areas which is giving is rural thrust. The spending on rural has actually come off, especially Narega. Last year, they spent around 900 billion rupees. For next year, they have about 600 billion rupees. So they've saved about, 0.15% of GDP there. But generally speaking, the rural thrust is a little weaker. The rural spending is a little weaker in FY24 compared to the last couple of years. A big question I've had from many of the companies who sort of are focused on consumer non-durables is, do you mean this is going to be bad for rural demand? And my answer is actually no. It's very interesting. But Capex for this government doubles up as a rural stimulus, believe it or not. With Capex, what you do is that not only do you create medium-term expansion to capacity, but you also create that construction job to build that road or to build that highway or to build that airport. And so in India, and as this government has proven over the last couple of years, they've basically done Capex in the worst of days, because that for them is also a way of doing social welfare. So my sense is there will be some sort of support to rural India from the construction jobs which will be created because of Capex. So, at first glance, it seems Capex versus rural, but if you look more closely, it is Capex and rural. So I think that's sort of like a positive. Then, I know I'm speaking a lot, but on this personal income tax part, in which they are trying to incentivize people via lower tax rates to move into a exemptions-free tax regime. It's actually a good thing. It's good to be in a very transparent sort of tax regime, because what happens with exemptions is that people of the same income level pay extremely different taxes depending on, if you're able to use up a loophole or if you are able to use up a particular exemption, which is not equitable. In tax theory, you want taxes to be equitable. If you have X, everybody with X income should be paying the same amount of taxes, right? So they're trying to move towards an exemptions-free kind of a tax regime. Will it happen? And my answer is that it's a little unclear, because the math that we did suggests that those people who are enjoying exemptions like HRA and all of that, they'll actually prefer the old system to the new system. So they may not be able to see a mass transition as they are hoping, but hopefully they will learn a few lessons and they will sort of make another attempt to incentivize this move next year. So that's on the personal income tax. On the tariff inversion, I told you, right, that this government has tried to incentivize manufacturing with PLI scheme and all of these things, but there were a lot of, I think, policy mistakes along the way. You want India to be a great producer of this massive output, but that massive output needs inputs. And if you have such high import tariffs on those inputs, then how will that output be competitive? So there was a lot of sort of too much import taxes, a lot of inverted duty structure, which is really hurting manufacturing, and they try to correct that. So, for instance, bringing down the import taxes on cameras and cell phones, or things like that, I think are going to help. We'll see. So that's another cleanup that they attempted. Overall, what is going to be the impact on the macroeconomy? A lot of foreign investors who look at India and who look at how sustainable India is versus another emerging market like Indonesia or Mexico, they look at public debt number. Public debt number wise, we are high. We peaked at 90% of GDP in 2022 at the heart of the pandemic. We've come down to 85% of GDP, but that's well above 75% where we were at pre-pandemic, and it's well above 60% where many of the other emerging markets who have our sort of per capita income are. So we have to work harder. We have to keep bringing down the fiscal deficit year after year. Only then the public debt will go down. So that's on public debt. On growth, as I said, it's a sort of a difficult year. Growth is going to be low. And the fiscal is also going to add to weaker growth, because at the end of the day, when the fiscal deficit comes down, it's negative for growth. Because how do you bring down the fiscal deficit? Either you tax more or you spend less. Both are bad for growth, right? So any period of fiscal consolidation takes away from growth. So we are going to have to bear the consequences. But I tell you, it's not a bad thing at all, because when you have little low growth, you also put a lid on inflation. And hopefully, this year, the inflation rate will be far more under control than it was last year. Last year, inflation in April, we had 7.8%. For FY24, I'm hoping it's going to be more like 5%. So inflation will be more in control. In a way, what I'm trying to tell you is that, it's a year to think about macro stability. It's a year to think about lower fiscal deficit, lower inflation, lower trade deficit, because with that, you set a very solid stage. And when global recovery really happens, your country's growth can take off. The best thing we can do for India's future growth is to not obsess about growth today. Let growth fall today, because growth is falling everywhere. Let it soften. Instead, focus on macro stability, because if by the end of the next 2 quarters, if we are able to bring down fiscal deficit, we are able to bring down inflation, bring down the trade deficit, and then global growth begins to recover again, we will be ready for takeoff. And I think, we should just be pragmatic and think a little bit into the medium term. So I think from that perspective, I think we are on the right track. Fiscal deficit has been low, and therefore inflation will also be low. One last thing is on CAD, the trade deficit. Last year was a big problem. Our trade deficit ballooned because oil prices were so high, but it was not just oil. Let's not hide behind oil. It was not just oil. Even our non-oil trade balance really plummeted simply because we were buying much more than we were selling. India's GDP growth was much stronger than world GDP growth. We were buying all kinds of things, mobile handsets, clothes, TV, AC, washing machine, and we were not selling all of those things. So our trade deficit really, really widened, and the RBI had to work very hard, selling a lot of dollars to keep the rupee stable. But over the last couple of months, we have also been able to take the right policy measures to narrow our trade deficit. We have increased interest rates. We have let the rupee depreciate in a trade-weighted basis. All of this actually incentivizes exports and disincentivizes imports. And my hope is going ahead, the current account deficit will narrow and the rupee will be more stable than we saw in the previous year. So, I think from that perspective, I'm happy that the next 12 months seems to me like a period of macro stability, which I think is necessary. And before I end, I'm going to just take 1 minute more. Positives from the budget, the fact that they were able to bring down the fiscal deficit while still doing Capex, and they attempted on some reforms on tax, on duty inversions and all of that. So those are the positives. Risks for me, the biggest risk is commodity prices. Today, fertilizer prices were to go up, the entire savings on the fertilizer subsidy bill would go away, and then the Capex thrust would go away because that saving has been used for the Capex. And also rural, we've cut back on Narega, but today if rural distress comes back, right now it's not looking like that at all. But if say a few months down the road, we have a bad monsoon and rural distress comes back, then we'll have to spend a little more on Narega than we had budgeted. So those are my two major risks. And my biggest challenge, the biggest challenge is implementation. We want to do a lot of Capex, and all hands will have to be on deck to make that possible, because it's very easy for a country like India to have implementation bottlenecks on the ground. So we'll have to overcome that, and I think that's going to be the biggest challenge. Having said that, I'm going to end with what I said, what I started with. This was an example of having your cake and eating it too, a budget that sort of tried to tick a lot of boxes. I'll end it there. Thank you for your patience and listening to me. And Nidhi, over to you for questions.
Yeah, thank you so much, Pranjul. I mean, we've read so much about budget, we have heard so much about budget, but the way you kind of presented everything in a nutshell for everybody to understand how to really deduce all the actions that they've taken, that was really brilliant. So thank you from all of viewers. And so I'll just start taking the questions, because we've been getting a lot of questions. So I'll start with this one. So basically, when you were talking, you had clearly very mentioned that it's very important that we have fiscal consolidation at this point of time and really pick that in front of growth if we have to really make a choice at this point of time for India as such. But even if we look at it at this point of time, every time when we have a budget, the difficult choice that the government has to really make between fiscal, controlling fiscal deficit or growth. So as an economist, really, how are you kind of, think of balancing, not at this point in time, what would really be something that an economist will look at in terms of the budget coming?
Yeah, look, I'm going to just repeat that lovely line which the chief economic advisor used in his economic survey day before yesterday, that fiscal discipline today is a fiscal stimulus tomorrow.
Yeah.
This is a marathon. We want India to grow at a high clip for a decade or more, because that's the only way we increase our per capita income, lift tons of people from poverty, move the middle class to upper middle class and beyond. We want growth for longer. If you look back into the history of growth in India, whenever we've had a few years of high growth, it's come back sharply after that, because suddenly inflation goes up, suddenly the trade deficit goes up, then the RBI has to come, hike rates, and then growth comes down. We've not been able to maintain high growth for long. That is what we need. And how do you maintain high growth for long? By looking after macro stability, making sure that inflation doesn't rise quickly, making sure that trade deficit suddenly just doesn't widen, like you grow a little bit, growth goes up from 5.8 to 6, suddenly you'll see the trade deficit widening, people buying a lot of stuff, importing a lot of stuff. How do you make sure all of that happens? And at the heart of that is the fiscal deficit. You always want the fiscal deficit to be sustainable. By sustainability, you mean rates, levels at which government is not borrowing too much from the market, because if the government borrows too much from the market, it crowds out private investment. Rates at which it is not artificially stoking consumption, because if you artificially stoke consumption, then you land up with a large import bill and a huge trade deficit. Fiscal deficit at sustainable levels is at the heart of solid medium-term growth. So I would go for bringing down fiscal deficit to sustainable levels because I want growth.
For putting it so beautifully and simply, so a growth that comes at the cost of fiscal deficit is, technically speaking, not really leading to good results, if I may put it that way, or long-term sustainable growth. Yeah,
Yes, exactly.
Thank you so much. Thank you. So I'll move on to the next question. Sorry, yeah. So the other question that we have, it's connected basically to Forex Reserve. You did mention about, the deficit, the CAD. So there is this change on the, under the LRS scheme, the TCS has been kind of increased. So they're actually talking about, does the government really want to dissuade, Forex outflows? Is it the situation a very precarious situation, or it's something that, they just want to discourage over long term?
Sorry, which
in terms of remittance, in terms of the remittances that you have under the liberalized remittance scheme, wherein, they are allowed to remit a certain amount overseas. So are we looking at a very precarious situation, or it's something that they're just trying to dissuade over a long term?
Well, look, those policy changes keep happening. One day they'll become a little easy, flexible. Another time they will bring a lot of controls. I think what we went through for the last couple of months was a period of control. What happened over August and September was that the dollar strengthened and strengthened. People were very scared around the world what's going on, rate hikes were happening, and everybody started putting their money into dollar assets, and the dollar strengthened aggressively. And as a result, all the emerging market currencies weakened. And then those emerging markets like India, whose sort of external accounts are weak, we have a large trade deficit, weakened even more. The RBI was under a lot of pressure to somehow bring back dollars, or to ensure that too many dollars don't leave the country. And it came up with a lot of different sort of rules and regulations. So it was a time in which regulations increased and became tighter. At another period, you may not find the same thing, right? At a time when we are having so much inflows that we don't know what to do with it. We've also had bouts of that. We don't know what to do with it. Then they make it very easy for you to sort of take money out. So it really depends on what's happening in the global economy. And I think these are policies that can sort of, it won't change every few months, but it can change every few years.
Okay. Thank you so much for that, Pranjul. So the next question we have in terms of, what we've seen in the banking system, we've seen a good period of, credit growth, and the balance sheets also getting strengthened over a period of time. But we're also seeing, a lot of, events or incidents, currently. So do you really think a banking system, with all the reforms and all the thrust that RBI has been doing, is really well placed and strong enough to take any kind of untoward incident, or they're really strong to deal with that?
Yeah, I think we've gone through the history of growth in India. I think we had a big problem just from 2011 to 2019, that period when suddenly non-performing loans at banks really jumped up, debt in corporate balance sheets really jumped up. Everybody was very scared. It was called the twin balance sheet problem. Investment tanked because nobody had the firepower to invest. And then we went through this entire reform, which under Raghuram Rajan and RBI, cleaning up bank balance sheets. In the beginning, it created a bloodbath. But I think coming out of that very painful situation, our banks are much more stronger than people think. In fact, on the eve of just as the pandemic started, everybody thought that, oh my goodness, the growth is going to be weak. People will not repay loans. NPLs at banks will rise, but that didn't happen. Instead, NPLs actually fell. And then there was so much liquidity in the market that the corporates were able to shed debt, and corporate balance sheets improved. So we've come out of 3 years of pandemic with much stronger balance sheets than we had before the pandemic, as in the irony of it all. So my sense is that, yes, I think we are in a place where we can take off. And one sort of indicator of takeoff is private investment. Because at the end of the day, growth is all about investment, right? You grow if you build the capacity to grow. And what is building the capacity to grow? It's private investment, right? So that is something that suffered for the last 10 years. But my point is that I think it's ready to take off. It hasn't taken off yet. And the reason is global uncertainty. Nobody wants to do investment when you have no clarity on inflation, commodity prices, interest rates, global growth. Hopefully, when the external environment stabilizes, we will see some of the private investment take off, because some of the, the stage has been set. We need the actor on stage now, and I think that should happen. To your question on some corporate accidents that may happen along the way, my sense is we have a large history, of like 30 years of being open and having a lot of foreign investors coming into India. Many of them have backed good companies, run well with good corporate governance, done well. And my sense is that, a few corporate accidents cannot really change that. So, we learn lessons and we sort of ensure we don't make the same mistakes again. But I would say at this point, I feel positively for India's growth and India's emergence.
Okay, thank you so much for that. We have this question. It's not really very connected to the budget, but I'll just take it since we have you here. So it's talking about, how there is this new thought emerging about, the reduced dependency on USD, and how, India could, maybe probably the INR could emerge as one of the other preferred, currency. So any thoughts, or do you think so how this entire roadmap could go ahead, or what's your view on the entire thought?
Yeah, I think this sort of keeps coming up, and we have sort of tried to do some steps on rupee internationalization over the last year. But look, we are not there. As in, let's be clear about where we are today. Our global share in goods exports is 1.7%. 1.7%. We are like a fifth largest economy in the world. We have huge ambitions, but our export share is only 1.7% of global exports. Only when you start trading, you have much more connections with different countries. You start, then there's a demand for your currency, right? If you have strong growth, your prospects are only rising over time. Other countries want to get connected with you. Only then, your sort of currency emerges, and your currency is one of those currency when people want to hold. It's great to have that ambition, and I hope we are on our way to towards that. But we are very far away from it right now.
Thank you so much. So the next question is about the new tax regime, where actually there are hardly any deductions or any savings. So it's pretty confusing that government is actually pushing a tax regime which doesn't really promote savings, for that matter. So that's pretty confounding. So any views on that?
Sorry, with savings?
The new tax regime under which you don't have any deductions as such. So basically, you're not really making any savings. So it's pretty kind of contradictory that you're actually promoting a new tax regime that doesn't really promote savings or retirement planning or insurance for that matter. So it's kind of difficult to read the entire action.
No, I think the thinking is quite the opposite. I think the thinking is that, as the new tax on insurance makes it very clear that the government did not want people to think about insurance as a savings instrument. Insurance is an insurance instrument, right? And savings is different, right? I think the sense here is different. It's the fact that people of the same income group should be taxed similarly. If today you and I are of the same income group and you have a HRA and I don't, why is your tax liability different from mine? HR is a completely different thing, and then when you have so many exemptions, you also get a lot of loopholes. And when you get loopholes, you have a lot of evasion. Globally, countries who over time have seen their governments get more revenue, which they're able to spend ultimately, are countries who have moved to more sort of transparent tax regimes. There's a lot of benefits from transparency. And then because it comes with a lower tax rate, the money that you save from there, you put it in some savings scheme, right? You do what you want. You buy an insurance scheme, you put it in FD, you do whatever. But why should you get a tax break for that was the big question, right? So So that, I don't think the move will happen. I think a lot of people will not move yet. But I think every year the government will try harder and harder to incentivize people to move.
Yeah, that's a very different way to look at it. So thanks for sharing that perspective. So the next question is, you talked about how, the Capex will actually help rural growth or, actually create, jobs as well. But if you read the entire budget, are there any specific sectors which you think would really benefit? Obviously, railways, you have that massive expenditure, infrastructure, but any fine print that makes you think that, okay, these would be the sectors for which it will be a game changer?
Well, the large infrastructure companies and then the companies that also supply to these large infrastructure companies, I think that entire those will really benefit. So I think obviously that's the main thrust. Then there's all kinds of like small things. In insurance will not do well because it's suddenly getting taxed. So I can tell you the negative list. I think some specific agri could do well, like agri tech, because there's far more sort of outlays for that. I'm not being able to tell you like many sectors, but I think I think Capex is the big one at this point. Real estate, I think again it sort of goes into the insurance bucket, because the very high luxury houses, there are some sort of tax adjustments there which will not be as easy as it was in the past. So I think there are lots of like winners and losers. But I just want to tell you one thing, all of these ideas that come out of the budget, they're never long lasting. One small change here or there in a budget for one sector has never made or broken a sector. A sector is made or broken depending on how your economy is growing. And how your economy is growing depends on a lot of the reforms and the macro stability your economy is doing. So, all of that sort of, gives you some excitement that, you want to buy this, buy that, but it's not going to change materially and permanently.
Yeah. Thanks, Pranjul. Again, I mean, it's really very interesting how we kind of extrapolate budget, but how the perspective that you're sharing really makes things very clear. So thank you so much for that. So I'll just move ahead to the next question. So there is this, focus basically on inclusive banking and, basically how, it would really aid in terms of lending to the priority sector. So do you see that, the unorganized or, not the large cap or not the bigger companies, would that be thrust for the SMEs or MSMEs? Would that really make a difference? Or it's again, something that's just there and it might just change over a period of time?
I'm a huge believer in how MSMEs could take off in India. And in fact, that is the India story. You see, today we can, use PLI and, what is PLI? It's 2 trillion rupees. What is 2 trillion rupees? It's 2 trillion rupees over 7 years. And 2 trillion, about 3 trillion is our fertilizer bill, subsidy bill for 1 year. And people have so much hope on this PLI. Great, it'll give some sort of initial seed money for some firms and all of that. But the real game changer in our country is if our small firms, our MSMEs, can be energized. They are large number of them. They employ people. Their problem is that too many of them remain too small for too long. They don't grow. Why don't they grow? They don't grow because they don't get access to credit. They don't grow because they don't get access to markets, both input and output, efficient markets. They don't grow because they don't get good access to technology, IT, logistics. They don't grow because they spend so much time dealing with this very difficult regulation in India. That's why they don't grow. Anything that will make MSMEs grow over time, so MSMEs become from small to medium and eventually they graduate to large and then earn economies of scale, which is how China grew. I think that will be the game changer for India's GDP growth. And I think the public digital infrastructure that we have now in our country, the India stack, is making that possible. Think about a startup which is focused on digitization of manufacturing, bringing together, say, 10,000 glassware companies. each of them were too small to make an impact or to ever grow or to ever become efficient. They bring 10,000 of those companies, they combine their orders, give them bulk discounts in the input market, combine their output, give them access to big, large export markets. They teach these small companies how to maintain a credit history, and then through credit aggregator get access to credit, bank credit, which they never got in the past, give them access to digitization of manufacturing, which is quality checks digitally, give them access to smart logistics, basically simulate scale, make a small company feel like they're a large company and they're simulating scale. If that can take off, then I think India can really grow high. It can grow at about 7.5 to 8% as well, which has been like a dream that we've had. The big thing for this would be continuous reforms that bring down the regulatory burden which small firms face, and also startups taking off and taking on more challenges. Right now in the first phase, most of India's startups focus on the services sector, started with e-commerce, then it went to some other interesting things like fintech, edutech, all of that, which is also very good. But I'm hoping they take on even more challenges. They get into the digitization of manufacturing, and then hopefully digitization of agriculture, which is agri-tech, because a lot of gains are to be had from those two sectors. I think India's real story will be there.
Okay. Thank you so much again for the interesting perspective. I'll just take one more question. You talked about, how the borrowing is at a certain number, and generally, there's always this concern that, where we are really going to see the demand for that. So how has been the reading specifically, just in terms of the borrowing or, the planned borrowing that the government plans to do for the fiscal year? Because there's generally a reaction immediately after that in terms of the supply that we'll see, in G6. So where do you expect, that to be?
Yeah, so this gross market borrowing of 15.4 trillion, people had feared it could be about 16 trillion. So right now people are just happy that it wasn't 16 trillion. But I think a few months down the line, people in the bond market will start wondering, 15.4, is it that low as we were thinking? Because last year they got addicted to banks buying a lot of the G6 and keeping, creating huge amount of demand. But this year, if credit growth and deposit growth slows, then banks may not have incentives to buy so many G6. And that could sort of, bid up the rates. So I think that problem could surface later in the year. A lot of it depends on how GDP growth itself will pan out. I think the problem will be there if GDP growth slows and a lot, and credit growth and deposit growth slow, and that SLR demand for G6 is not there, LCR demand for G6 is not there. And then I think we'll have a problem in the bond market. So it's the sort of moving parts, it's possible that eventually credit doesn't slow very much. So anything is possible. There are many uncertainties out there. My sense is overall, I don't see a huge rally in the 10-year. As in, I think that even the 15.4 trillion is a pretty large number. And the market will have to slowly keep digesting it through the different auctions. I can't really see a big rally on the 10-year on the back of that. The other thing is inflation. I'm expecting inflation to come down, but not expecting it to go all the way down to 4%, which is the RBI target. And I think it'll be hard for RBI to cut rates at a time inflation is nowhere close to the 4% target. So I don't see a bond rally on the back of RBI rate cuts either. That those are some of my views on G6.
Okay. So I guess that's a pretty interesting thing that you have these budgeted outlays, numbers and figures, the budget has presented, but you really have a lot of moving parts and you really kind of see how things pan out. So at this point of time, it might really seem good. I mean, I'm not saying it's going to be bad, but it's like just the beginning, and we have to really see how it pans out to really not kind of deduce things immediately for that matter.
Right. And things may change, and you have to just be smart about when you enter and when you exit and all of that.
Yeah, that's there. The other thing, I'm sorry, I'll just move to the next question. So the other thing that you had mentioned, when you were talking about budget, that how they have kind of assumed a tag buoyancy of 1%. At the same point of time, in terms of fiscal, in terms of GDP growth also, they've assumed 10%. There's another thing that a lot of people are talking about is the disinvestment targets, which don't really seem to be meeting. I mean, we've had a history of not really meeting the disinvestment targets. So do you think that is also one of the things which is a little bit overestimated, or a very sanguine estimate that they've put?
No, I think there's a big overestimation there. As in the best of years, we've not been able to meet the target. I really doubt we're going to meet it in a pre-election year. As in, honestly, I'll put a 0% probability to that. Because it's a very high number. It's 510 billion. It's just extremely high. This whole disinvestment activity comes to a standstill in pre-election years. So I think there could be a lot of disappointment there. But, I'm not going to worry too much, because as I mentioned in my opening remarks, that there's this another category in non-tax revenues called RBI dividend, which is the RBI profits that RBI shares with government. That could be much higher than the government has estimated at this point, because the RBI has made a lot of profits this year. So that could offset some of the disappointment in the privatization, at least for FY24. So those are my thoughts of FY24. But beyond FY24, I told you, right, we need to bring down our fiscal deficit for several years. And beyond FY24, I think privatization has to play a big role in India's fiscal consolidation path. Otherwise, we will have to just tax a lot or really cut down on spending, and both are not possible. Privatization has to ramp up. It really has to. And I think there's some good news there. We are a strange country, Nidhi, really. We got the hardest disinvestment done, which is Air India, which had so many accounting issues, like baggage from the past, legacy issues. It was the most complicated disinvestment. Like, I still remember that in the day we got the news at around 12 noon that Air India disinvestment has happened, that day there was an op-ed by a very senior policymaker saying that Air India disinvestment will never happen. Like, nobody could imagine, that could happen. We did that. And I think that was like a watershed moment when the bureaucracy came together and realized we can do it. And okay, fine, there can be a pause because it's a pre-election year. But I'm hoping once the election is done and it's the same cast of characters in the bureaucracy, they will try to restart the disinvestment and privatization process.
Thank you so much for that question. I guess we haven't received any more questions, but any closing remarks, Pranjul, just to kind of, honestly, you had put it very clearly. Just one thing that you would sum up this budget with, just one line or two lines probably.
Yeah, I think, the central government was able to have its cake and eat it too. It basically brought down the fiscal deficit, batted for macro stability, and it also, gave a push to Capex, which is, think about medium-term growth. It's very rare for these two to coexist, but they did coexist yesterday. I can have a lot of quibbles about many small fine prints in the budget, but I think overall, I would not have been able to better it.
Okay. Thank you so much, Pranjul, for taking out time for this session. We'll close this session now. And I'm sure that all our viewers have really gained, a lot of key takeaways from the budget and really understood, how to actually read the fine print and read the numbers. So thank you, everyone. Thank you, Pranjul, and good evening to everyone.